Chapter 2: Types of Investments. This book is mostly about investments in stocks, but an informed investor should understand the whole spectrum of possible assets. Investments have many forms and types, one better than the other. In this chapter, we will analyze common forms of investments, their benefits, and relevant risks. It is easier to see the possible benefits of an investment, but a lot harder to analyze and understand the inherent risk that comes with it. Good old cash. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Warren Buffett. Cash can be kept in government-issued bills under the mattress, or more commonly, as balances in checking or savings bank accounts. However, an investor must understand what the cash represents. Government bills are debt instruments issued by a sovereign authority that pays zero interest. It derives its value from its issuer's creditworthiness, the sovereign government. In essence, it is a derivative, and its value fluctuates with its underlying variables. Benefits of cash investments. Cash is not all trash. There are a few benefits of keeping your capital in the form of cash equivalent. However, the cons of keeping your capital in cash outshadow its benefits. Liquidity. Cash is liquid, and it is super easy to convert it into other assets. There are times, but not very often, when cash is king. When all other asset classes are overvalued, it is better to keep your powder dry and keep your money in the form of cash investment. No price risk. Cash pays no interest. The $100 bill will always be a $100 bill, no matter how long you keep it in your pocket. A positive outcome of zero interest is that cash is not exposed to the price risk. Other debt instruments that pay some interest are exposed to the possible price fall. Their prices move up or down, depending upon fluctuations in the interest rate environment. A more detailed analysis of this concept can be found later on in this book, in Debt Instrument Discussion. Risks attached to cash and bank deposits. It is foolish to believe that cash in the form of bills or your bank account is not exposed to any risk. Sure it is. So, you better be aware of all forms of risks that come with cash investments. Inflation risk. The number one risk that is associated with cash investments is inflation. The value of cash decreases with the rate of prevailing inflation. $10,000 invested in cash today will be about $1,350 in 100 years with 2% inflation. With zero interest, cash will earn a negative rate of return equal to the prevailing inflation rate. The inflation risk is a common attribute of all cash-based instruments, regardless of the respective interest rates. Foreign exchange risk. If you invest in foreign currency, you are exposed to the conversion risk, or as commonly known, foreign exchange risk. It is possible to hedge the risk, but all hedging strategies come with a cost and a risk attached. As a rule of thumb, most of your assets should be in the strongest currency, and most of your liabilities should be in the weakest currency. Credit risk. It is a big misconception that cash does not suffer credit risk. As we have learned before, cash is a debt instrument issued by a sovereign government, and all debt instruments are exposed to credit risk. All debt instruments are subject to the creditworthiness of their issuers, so is cash. The value of cash deteriorates when the creditworthiness of its issuer declines. There are times when the value of cash goes down to zero. The Zimbabwe dollar is the most recent example. Now take this concept of credit risk one step further. You had cash in the form of bills issued by the government, and then you deposited your cash with a bank. In essence, you gave your money to that bank on loan and bought another debt instrument. Bank acknowledges this debt in the form of a deposit slip and periodically in the form of your bank statement. This debt investment may or may not pay any interest. As you have layered another debt instrument on top of your original cash, you are now exposed to additional credit risk, the creditworthiness of your bank. Your investment in a bank account is as secure as your bank is. If your bank goes bankrupt, so does your investment. Your government or any government-mandated insurance company may cover you for a portion of your money. However, beyond that, you will be in line with all other creditors of the bank to recover your money out of leftover assets. Your position in line depends upon the type of debt you bought from that bank. Gold and other precious metals. Precious metals are common and sought-after investments, and gold and silver are the most common choices. Investment in precious metals comes with its own unique set of risks and rewards. Many investment vehicles will give you exposure to the precious metal of your choice. You can buy physical gold bullions or coins and keep them in a safety deposit box. Gold certificates from a central holding company or a gold mutual fund or ETF are other alternatives. Sure, there will be times when you want to keep some of your investments in the form of precious metals. However, before you buy some gold, let's discuss the pros and cons of investing in precious metals. Benefits of investments in precious metals. There are multiple benefits of keeping money in the form of gold or some other precious metal. Some benefits are more evident than others. Let's discuss these benefits first. Little to no inflation risk. In the short term, gold prices may go up or down and create an illusion of change in the value of gold. However, gold has kept its real value intact over a long-term basis. For thousands of years, gold and other precious metals have been being traded. You can buy nearly the same amount of goods today with an ounce of gold as you could buy thousands of years ago. As gold prices have moved up with inflation for thousands of years, we can safely conclude that gold will keep its value in our lifetime, despite short-term fluctuations governed by market supply and demand. Holder of value. Gold is a kind of investment that derives its value from an acceptable price for willing buyers. In other words, it is a bigger idiot type of investment. However, gold has been a reliable holder of value over thousands of years. Liquidity. Physical gold and other precious metals are not as liquid as cash, but are liquid enough to be considered liquid assets. You can convert your gold into cash relatively quickly. Other forms of gold and precious metals, like gold certificates, mutual funds, and ETFs, are very liquid, and you can convert these to cash with a click of a button these days. Scarcity. Gold and other precious metals are valuable because of their scarcity. It is the supply and demand mechanism that ensures the value of these metals. Gold is rare and hard to find, plus it is expensive to extract pure gold from its ores. These metals have kept their value for thousands of years because enough people believe so. This characteristic keeps the demand and value for these metals stable over time. Safe haven. Gold and other precious metals are widely considered a safe haven during challenging times. People rush to buy these assets in times of recession and wars. After the 2008 financial crisis, the per-ounce price for gold rapidly rose to over $1,900 within 3 years, only to go back to below $1,200 in the next 3 years. It was the perception of a safe haven that drove prices of gold to unrealistic highs. Risks of investing in gold and other precious metals. Besides the risk of being stolen, physical gold or other precious metals are exposed to only one significant risk. These metals do not create any income. An ounce of gold will always be an ounce of gold, regardless of the length of possession. The short-term value will go up or down, but gold prices will follow the general inflation rate in the long run. Other forms of metal possession, like gold certificates or ETF, have their own sets of risks. Most significant among these are credit risk and liquid market risk. Paintings, coins, and other collectibles. Collectibles are commonly referred to as investments, but these are not investments in the true sense. If you buy a painting as an investment, you hope to sell it at a higher price to a willing buyer. A collectible's value is primarily based on the emotions and the perception of potential buyers. There is no reliable expected rate of return, and value can be widely fluctuating. That's why I keep collectibles on a zero intrinsic value category, where investors are waiting for a bigger idiot. Occasionally, collectibles are sold multiple folds of original amounts, but lose their value in the long run. A baseball bat that scored a home run in the most recent championship match may be precious today, However, after a century and after many home runs in later championship matches, this particular bat will attract very few buyers. The memory of that spectacular night will fade away. It is a game of hot potato. The person who was holding it last will lose. Real estate investments. Real estate is generally the first, and for the most part, the most significant investment decision. When you buy your first apartment, you become a real estate investor regardless of its purpose. You are now exposed to all of its pros and cons. You would better understand to avoid any potential pitfalls. The biggest mistake people make is buying a piece of property for their current purpose. If you purchase a studio apartment for your personal use, consider selling it in the future when your life changes. You change your job, or the composition of your family changes, so you will need to sell the property. If you haven't thought about selling it at the time of purchase, you will find it difficult to sell, even at a compromised price. Besides properties for personal residence, real estate is bought for two main reasons. First, to sell it at a higher price after improving its value through better marketing or tangible improvements. Secondly, to rent it out and collect cash to cover your mortgage and maintenance costs. In both cases, you must consider selling it in the future. Like any other investment, real estate comes with its own set of risks and rewards. Let's discuss these briefly. Benefits of real estate investments. By any standard, investment in real estate is advantageous and can substantially increase your wealth over time. The total return of a property that can be rented can easily beat any other investment type. The combined rate of return of capital appreciation and rental income is substantially better. Holder of value. With few exceptions, a real estate property holds its value. Generally, capital appreciation of a well-situated property is substantially higher than the prevailing inflation rate. Expansion of urban boundaries keeps the demand up. For a short period, prices may go down, but tend to go up at least with inflation on a long-term basis. Properties can generate rental income. Most real estate properties generate rental income. Even if you live in your property, consider it a rental income because you will need to rent a house otherwise. When you buy a piece of property at a reasonable price, it will generate a positive cash flow immediately or shortly. Through rental income, you can cover your mortgage payment and other maintenance expenses. Over time, you repay part of your mortgage and build considerable equity. However, to make a successful real estate investment, you must analyze potential cash flows and price-to-earnings ratio, PE ratio. Leverage. Real estate is the most leveraged investment of all, and leverage is the most overlooked factor when deciding on a real estate investment. Consider this. You are buying an apartment as an investment and will be renting it out. Your bank is satisfied with your credit situation and the value of the subject property, and you are offered a 5% down payment with a 95% mortgage. You are leveraged 20 times of your equity, and it is acceptable only in the real estate world. Even on the higher side, if you are asked to put 20% down, you are still leveraging your equity 5 times. Leveraging 20 folds is considered crazy in capital markets. Investors with years of experience do not dare to expose themselves with that much leverage, but it is common in the real estate world. Higher leveraging of real estate investment is the source of higher returns. However, it can cause significant losses. One bad investment can ruin your investment career along with your wealth. Risks of real estate investments. As mentioned above, all the benefits of investing in real estate come with some risks worthy of discussion in detail. Not a liquid investment. Real estate properties are the most illiquid investment. There is no market where you can trade your property for quick cash conversion. Buyers of your property are limited to other real estate investors in your area. You need to put your property on the market and wait for a reasonable offer. Sometimes it is quick, and sometimes it may take years. Even after selling your property, actual cash settlement may still take months, as the legal process of transferring the title is lengthy and requires lawyers to complete the transaction. Not finding a suitable renter. It is possible that your property is idle for some time and you cannot find a suitable renter. You are still required to pay your mortgage and other bills. There could be situations where you are stuck with a problematic tenant. Property damages, depreciation, and general maintenance. Real estate properties are tangible assets that are subject to physical damages, either intentional or accidental. Keeping an appropriate insurance plan with a reputable insurance company can cover this risk for the most part. All tangible assets, other than land, are exposed to general wear and tear over time. Another form of depreciation is obsoleteness, when a type of building is out of fashion or impossible for its intended purpose. Consider a windmill. It could have been a useful property back in time, but now windmills are no longer required. Consider a hip, out-of-the-box type house that was the talk of the town in the 70s, but over time, the taste of people changed, and the new generation calls it the ugly bungalow down the street. All properties need constant maintenance. A house exterior is exposed to elements, and the interior is used by its occupants year after year. Without maintenance, your property will quickly turn into a mess and require a larger amount to fix. Avoiding a small maintenance cost will soon turn into a larger problem. Capital markets investments. Capital markets consist of two markets: the debt instruments market, commonly known as the bond market, and the equity instruments market, widely known as the stock market. Companies raise cash for their business in two ways. They can borrow some money for a specified time and pay a fixed or variable interest. Borrowers issue certificates of debt to the creditors. These certificates are called debt instruments or bonds. These instruments are tradable, and the general public can trade them in the bond market. In addition to the corporate bonds, the government issues debt instruments to raise cash. These are called government bonds. Generally, government bonds enjoy better credit ratings than the corporate equivalents and pay very low interest. Another way of raising cash is to issue equity instruments like common shares. These are not repayable, but are permanent investments. There are other hybrid ways to raise money, like subordinated debt or convertible loans, but generally, these securities are not traded in public markets. Only institutional investors have access to these securities. Retail investors may invest in these securities through hedge funds or private equity firms. Debt instruments or bonds. Governments and companies issue bonds in different forms and types to raise cash, but all of these bonds are repayable loans of varying maturity and interest rates. For all capital market investors, especially bond investors, it is essential to understand how the following three factors impact bond prices. 1. The credit rating of the issuer. 2. Interest rates or coupon rate of the bond. 3. The maturity date of the bond. Credit rating. The borrower's creditworthiness is the most crucial factor for any investor or the person extending their money. When you buy a bond, you essentially become a creditor of the issuer. Bonds are categorized by their issuer's creditworthiness. The government enjoys the highest rating, and generally, government bonds are called risk-free bonds. Very few companies achieve the same rating as government bonds. Bonds are rated from AAA to D, as AAA is the highest rating, and D is for default. AAA rating is higher than AA, and AA rating is higher than A. From AAA to BBB, bonds are called investment grade, and from BB to C, they are called high yield or junk bonds. Credit ratings of bonds govern the effective interest rate or yield, as called by investors. Companies with higher credit ratings can issue bonds at lower rates, and lower grade bonds are sold for higher yields. Coupon rate. When a bond is issued, it contains a periodic payment of interest, normally biannually. The initial interest rate attached to the bond is called the coupon rate. In the old days, bond certificates used to have coupons attached to the certificate that an investor could cut and take to the issuer to receive the interest payment. Today, thanks to central depository systems, interest payments are paid directly to investors' accounts. The original loan amount is paid at the maturity date, and the bond expires when the principal is paid in full. There are variations of this most common type of bond. For example, some bonds are perpetual, meaning these bonds are only required to pay interest, and the original principal is never paid back. Another variation is money market instruments, where bonds are issued on discount and matures at par. In layman's terms, investors pay a smaller amount at the time of purchase and receive full par value at maturity. The difference between the amount paid and the amount received is called interest. However, in the real world, interest demanded by investors fluctuates. Today, an investor wants 2% interest for a bond, but tomorrow, he may ask for 1.9%. The demand and supply of bonds govern the market interest rate. Effective yield. Suppose you buy a bond today that gives you an interest of 5% for 3 years of maturity. However, next month market rate has moved to 6% for the 3-year bond. Your bond is less attractive for other investors than a bond that can give them 6% interest. If you want to sell your bond, you will need to match the 6% interest rate, so the potential buyer becomes indifferent between your bond and the other bonds. You will need to reduce the price of your bond so the buyer's effective interest rate will be equal to 6%. The reduction of price in bonds is called a discount. On the other hand, if the market interest rate goes down to 4%, you can demand a higher price for your 5% bond. This price increase is called the premium. The value of any bond has an inverse relation with the market interest rate. When interest rates go higher, the value of bonds goes down. And when interest rates go down, the value of bonds goes higher. When investors buy a bond with a premium or discount, their effective interest rate is different from the coupon interest rate. This new effective interest rate is called an effective yield or yield to maturity. Maturity date. Most of the bonds have a maturity date, and on that date, the borrower pays the par value of the bond to the investor, and the bond is deemed expired or matured. It cannot be traded anymore. Sometimes a bond's prospectus lists some events. If they occur, the maturity of the bond can be extended to a later date. These events are called trigger events. In the 2008 credit crisis, several bonds had to postpone their maturity dates beyond the actual intended date. Some debt securities pay a portion of their principal amount with every interest payment. Generally, asset-backed securities have this characteristic. These securities are called amortizing securities. If the bond is unable to pay the principal amount on the maturity date or during its lifetime, any interest payment is missed. The bond is considered in default. The issuer may file for bankruptcy, and relevant laws will be applied. Investors will receive a portion of their money through the bankruptcy process. Relationship of maturity date and bond prices. Bond prices depend upon fluctuations in the market interest rate with an inverse relation. However, prices of fixed-rate bonds are directly related to time to maturity. The longer the time to maturity, the larger the impact on prices. The price of a bond maturing in 30 years will go down more than a bond maturing in 5 years if the rates have gone up. Remember, it is the time left to maturity that matters, not the original maturity. In other words, a 30-year bond issued 25 years ago will have the same impact as a 5-year bond issued recently. Floating or variable interest rate bonds. Another concept that is important to understand is that not all bonds have a fixed coupon rate. In variable interest rate bonds, the interest rate is reset at a specified date with a specified reference or benchmark rate, like 3-month U.S. Treasury bill rate, 3M T-bill. Sometimes a spread or margin is used on top of the benchmark rate. This spread can be positive or negative. The event of resetting the interest rate is called repricing. An example of a repricing schedule of bonds can be like resets every January 1st, April 1st, July 1st, October 1st, with 3-month U.S. Treasury bill rate plus 90 basis points. In this case, this bond will reset its interest rates on these days as a 3-month U.S. Treasury bill rate plus 0.9%. This 0.9%, or 90 basis point, is the spread, and it can be negative or positive. Floating rate bonds have a special place in portfolio management because of their repricing mechanism. As these bonds are repriced with the market every so often, changes in market interest rates have little to no impact on bond prices. In other words, these bonds are immune to interest rate fluctuation impact on prices. When an investor believes that interest rates may go up and fixed rate bonds prices will go down, They may want to sell their fixed-rate bonds and buy floating-rate bonds instead. This buying and selling may trigger some taxable events. Sometimes, instead of buying and selling, investors only swap the interest rate through an interest rate swap with a counterparty. This strategy is available only to large investors, and retail investors, like you and I, will have to take the capital gain and pay the required taxes. Yield curve. Suppose you draw interest rate and maturity dates on a graph where x-axis is the maturity date and the y-axis is the interest rate. In this case, you will get an upward trending graph as longer maturity demands a higher interest rate. This upward trending graph is a normal yield curve and exhibits a healthy credit environment. However, in stressed credit environments, the yield curve may inverse when a shorter maturity bond's effective yield is higher than the longer term. This upside-down pattern is called an inverted yield curve, and it is widely believed that an inverted yield curve is a sign of a stressed credit market, and a recession is not far away. Negative yielding bonds. In 2019, about $17 trillion of the world's sovereign bonds were yielding negative interest rates. The United States was among the very few developed countries where bond yields were still positive. However, it stressed the yield curve, and it was inverted for some time. It is an extraordinary phenomenon of the credit market when bonds are so high in demand that the effective yield of the bonds crosses zero interest rate and goes to negative territory. On the surface, it is hard to believe that any sensible person buys a negative yielding bond. It is a guaranteed loss. You will receive a lesser amount on the maturity than what you are paying. However, the other option is to keep the money in the form of cash with your bank. We have learned earlier that when you deposit your money with a bank, you are giving your money to the bank on loan, and your money is only as secure as your bank is. In stressed times, investors don't want to invest in equities, as an equity instrument like stocks can go down significantly in value. They don't want to give it to a corporation, including banks. The only sensible choice is to give the money to the highest rated borrower, the government. In these times, demand for sovereign bonds goes up so much that investors are willing to accept negative interest rates to keep their money in government bonds. They are essentially trying to protect themselves from larger possible losses, and a negative interest rate is their hedging cost. It is hard to conceive that few investors stress the markets so much that bond yield goes negative, but always remember that effective yield is the function of prices, and the minority dictates the price. It is the sentiments of very few shaky investors that push the prices of bonds to unsustainable highs. However, current trading prices apply to all investors, regardless of their trading activity. Another reason that magnifies the negative interest rate environment is the mandatory purchases of some market players like mutual funds, pension funds, and insurance companies. These companies continuously have an influx of funds through automatic deductions from general public salaries or insurance premium payments. They cannot do any other thing but buy bonds, regardless of prices or effective yield. We have learned before that effective yield has an inverse relationship with bond prices. When the yield goes down, bonds prices rise, and rising prices don't go unnoticed. Market speculators and gambling-minded players come into action and amplify the impact. However, this is generally the last stage, and signs of bottom soon appear. Risks and benefit of debt instruments. Recently, one of my friends described his newly found investment strategy. He sells part of his equity position as his portfolio's total amount goes beyond a specific number. For example, $100,000. Every time his entire equity portfolio touches $110,000, he sells $10,000 worth of stocks and buys fixed income securities. In his opinion, he was locking in the profit he made in equity securities. He thinks debt securities are risk-free and will earn the coupon rate until he finally decides his principal to move back to equity securities. He certainly does not understand how fixed income securities function and how the valuation of these securities fluctuates. All debt instruments share some common risks and rewards. Before you include these in your portfolio, it is wise to understand. Let's discuss some of the benefits of investing in debt instruments. Benefits of debt instruments. Debt instruments have a senior claim than equity instruments. Seniority means the right to be paid first. Debt instruments have senior rights on a corporation's assets than equity instruments. In plain English, it means a company pays back its loans before any penny goes to shareholders. In liquidation, investors of debt instruments will be paid first, and the rest goes to shareholders if anything is left. Some debt instruments have more senior rights than others, but all debt instruments are senior than equity instruments. For example, subordinated debts will be paid after all other debt instruments are paid in full, but before any penny goes to equity holders. The interest rate is guaranteed. Debt instruments are loans, and the contractual interest rate is guaranteed regardless of whether the corporation is making a profit or loss. Investors are guaranteed a specific rate of return, and the corporation is contractually obligated to pay the principal plus any unpaid interest. Debt instruments can cushion a significant downturn in the equity market. In theory, a portfolio's debt instruments portion should rise in value when equity instruments are in a significant downturn. In the stressed equity market, like 2008, the most popular tool in central banks' toolbox is to increase the money supply. To increase the money supply, the central bank drastically reduces the interest rates. As the interest rates go near zero, any fixed-rate bond's value increases depending upon its time to maturity. If you are holding a large portion of your portfolio in debt instruments, your portfolio's overall value may not go down significantly, or perhaps it will increase. Because of this theoretical advantage, many investors keep a significant portion of their portfolio in the form of debt instruments. There is no shortage of different equity and debt securities ratios advised by leading money managers. Everybody claims their ratio is the optimal ratio to split your money. The mutual fund industry also offers mutual funds with different ratios. A mutual fund that has a higher percentage of equity portion is called a growth fund. When equity and debt investments are divided with equal percentages, the fund is called a balanced fund. When a higher percentage of money is allocated to debt securities, the fund is called an income fund. In my opinion, there is no optimal ratio for equity and debt distribution of a portfolio. Different times require different splits. For example, in 2000, when equity securities were insanely valued and the price-to-earnings ratio was touching the sky, prudent investors should have moved most of their funds into debt securities. On the other hand, in 2009, when equity valuations were significantly lower and the effective yield of bonds was at its bottom, a higher equity portion was a better choice. It all depends on the equity valuation in general and the prevailing interest rate environment. The risk attached to debt instruments. Inflation risk. Debt instruments are cash-based, and all cash-based instruments have inflation risks in common. The true value of your money goes down by the rate of prevailing inflation. As we have learned earlier in the discussion of cash, $10,000 invested today will have an approximate value of $1,350 in 100 years with 2% inflation. Whenever you buy cash-based security, you must consider the prevailing inflation rate to arrive at a true rate of return. Credit risk. All debt instruments are loans to a counterparty, either government or corporation, and all loans are as secure as their borrower's creditworthiness. In everyday language, we say that we are buying debt security, but in essence, we are extending the loan to the issuer of the security. Issuers of debt security are contractually obligated to repay the loan on specified terms. As a prudent lender, you must investigate the borrower's creditworthiness before you hand out your hard-earned money. Price risk. As we have learned earlier in this chapter, the price of a debt security may go up or down depending upon fluctuations in the interest rate environment. You should avoid buying debt instruments with low effective yields, especially long-term fixed-rate securities. If you need to park your money in debt instruments and market yields are at the bottom range, your best choice would be buying short-term floating-rate securities with the highest possible credit ratings. In these situations, short-term floating-rate treasury bills are usually the best choice. Foreign exchange risk. If you are holding foreign-denominated debt security, you are exposed to foreign exchange conversion risk. Suppose the value of the relevant foreign currency goes down in relation to your local currency. In that case, your investments in that currency will go down when translated back to your local currency. You will receive fewer local dollars, even if your investment increases in value in terms of foreign currency. Equity investments. The equity market is a hypothetical marketplace where common people can buy or sell their equity shares of different corporations through their brokers. Nowadays, it can be done with a click of a button in the comfort of your home. You do not need to go to a market to trade a share. Common shares are proportionate ownership in a corporation, and you share both the profit and loss of that company. If your corporation makes a profit, a portion is allocated to you. When it makes a loss, a piece of that loss is assigned to you. The pros and cons of equity ownerships are easiest to explain, at least in theory, but these are hardest to calculate because of their unknown nature. Benefits of equity investments. Limited loss and possibilities of unlimited profit. A unique characteristic of equity investment is that potential loss is limited to the amount of investment. You cannot lose more money than what you have invested. However, on the other hand, the possibilities of profit are unlimited, at least in theory. The price of a share can reach any amount. The price of Apple reached more than 1,000 times from its inception to the year 2020. If you have invested an equal amount in Apple and 1,000 other companies at their inception, and all other companies go bankrupt, you are still in profit. This is the power of unlimited gain possibilities and limited loss. Limited inflation risk. Although inflation affects businesses in the short term and the prevailing inflation rate influences the government's fiscal and monetary policies, equity prices are adjusted in the long run. If you are a long-term investor in a stable business, you should expect your corporation's price to increase with the rate of inflation. For example, you have invested in a beverage company that sells 1 million soda cans per year and makes 1 cent per can profit. The total profit for the year will be $10,000. However, next year with inflation, this company sells exactly 1 million cans but makes 1.02 cents of profit per can, and the total profit rises to 102% of last year's profit. In a higher efficient market, this increase in profit, although with no organic growth, should be reflected in share prices, and price per share should go up by exactly 2%. Markets are inefficient and erratic in the short term. However, all possible information becomes available to all investors in the long run, and in the long term, markets become highly efficient and have limited inflation risk. An exception of this rule is a hyperinflationary environment, when relationships are so distorted even in the long run. Prices will never catch up, or business realities are changing so fast that trading market fundamentals are broken. Risks of equity investments. Perpetual investment. Equity instruments are perpetual investments. Companies are not required to pay their shareholders in the ordinary course of business. You can only sell your equity share to somebody else. In case of bankruptcy, common shareholders are standing at the very end of the line. As they are the business owner, they are paid in the end if anything is left. No guaranteed rate of return. Shareholders are the owners, and like any other business owners, they share both profits or losses. There is no fixed rate of return on their capital investment. If the business does well, owners do well, and when the company does poorly, owners share the pain. Short-term price risk. Equity ownership of public companies can only be sold to another person. However, stock prices can be depressed for a while. In the long run, prices always return to their actual value, but you may suffer significant losses if you are compelled to sell your investments during a recession. Chapter takeaways. Cash and bank deposits are not risk-free investments. They suffer substantial hidden risks like inflation, credit, and foreign exchange. Precious metals are a little better than cash, but still a terrible investment from a long-term investor's perspective. Bonds and stocks are the two components of the capital market. It is essential for a stock investor to understand the pricing model of the bonds. Bonds and stocks are the two ways a company can raise money. However, in case of bankruptcy, bondholders will be paid before equity holders. In exchange, equity holders enjoy the possibility of unlimited profit.